Well, let's check in now with Peter Churchouse. Peter is the director at Lim Advisors, and he joins us live from our Hong Kong studios. Peter, is it safe to say, judging from or based on these comments that we are getting, that investors would be better off if you're long-term just jumping right into China and India with both feet?
Well, quite frankly, Asia markets right now do look significantly cheap, both on an absolute basis and on a relative basis, relative to the US and relative to developed markets. These markets are trading at around 11.5 times forward earnings right now. They're trading at about 2 times price to book compared to over 3 times for the US. And the markets in Asia are trading at a return on equity of around 15 to 15.5%, which is the highest ever that we've seen in Asia. So on many accounts, the Asian markets do look, both absolute terms and in relative terms, relatively well priced right now. However, we do expect to see earnings growth slow down sharply in 2005.
Now, that's exactly what I wanted to ask you. Oil prices are up there, rates are going up, and we are expecting earnings to start coming off. To what extent has that been priced into Asian shares? Would investors be better off waiting, say, 6 months to a year before really jumping in?
Well, I think it's been reasonably well priced in already. Expectations for earnings for this year, for 2004, are around 40% earnings growth for this year compared to last year, albeit that's coming from a very low base. And next year, however, we're looking to see Asian earnings, consensus earnings forecasts are for less than 10% earnings growth next year. So the market, I think, is well geared into the fact that growth is going to slow down and earnings growth is going to slow down. But that's pretty well reflected in very low prices of the stock. So I'm not sure we're going to see prices get any cheaper as far as Asian stocks generally are concerned.
Peter, Philip in Hong Kong, speaking of prices, how about prices of consumer goods on the PPI front? We just flashed it a moment ago on the screen, 8.4% in the year through October. This is the fastest rate of growth in at least 7 years for China. Is that a concern for you when you talk about earnings? That's going to eat into corporate profits, corporate margins, and we haven't begun to talk about CPI yet.
That's absolutely correct. That's exactly the trend we've been seeing all the way around the markets in the last 6 months or so, is that producer prices have been rising more rapidly than consumer prices. This is telling you that producers are having to take the hit in terms of these higher prices because they're not being able to pass these prices on to consumers. So we're seeing a very significant differential between producer prices around the region and consumer prices. So that, I think, is also feeding well into this theme of slower earnings growth next year. At some point, I think, however, we are going to see CPI edge up as producers are not able to continue to take the hit on these higher producer prices. So CPI, I think, is headed up in countries certainly in China, in Hong Kong, and perhaps even also in Japan. And that, quite frankly, in Japan will be a good thing.
Peter, let me translate that very briefly. Essentially, what you're calling for is an earnings recession. Is that correct?
Well, it's not an earnings recession, but certainly an earnings slowdown. Recession, I think, would mean we would, in many countries, be in negative earnings growth. That is not the case. That happened in 2001, 2002. We're still in positive territory. Economic growth in Asia is going to be somewhere just below 6% next year, from just above 6% this year. That's not a really dramatic slowdown, but it certainly is. We're coming off the boil that we've seen over the last 12 months.
Peter, what's your thoughts on South Korea? We just had a few minutes ago a surprise rate cut over there, 25 basis points. Is that economy something that you would stay away from right now as an investor?
Well, interestingly enough, the Korean market always looks terribly cheap in these kinds of circumstances. But funnily enough, the Korean market doesn't really trade on valuations. Many of the other markets in the region do tend to respond to cheap valuations. Quite frankly, we're a little bit cautious about Korea right now. And in some respects, we're much more focused in Southeast Asia, which I think is perhaps a bit of a non-consensus call. For example, Singapore looks very interesting. Malaysia, with new leadership in Malaysia, we are seeing, I think, some very interesting prospects in those two markets. So interestingly enough, we would be a little bit more focused in Southeast Asia right now rather than in markets like Korea.
Okay, what about the Fed over in the United States? We had a rate hike overnight, 25 basis points. What are you expecting in December?
Well, I think, quite frankly, the Fed does look like it is going to continue to tighten over the course of the next 6 months or so, probably another 50, maybe 75 basis points. We're still in a point where we've got a very accommodative monetary policy in the U.S. So I think we are going to see the Fed gradually trying to get towards a more neutral policy. At the current interest rates, we're now in a territory where interest rates are just creeping into positive territory in real terms. So we've still got very accommodative monetary policy. So my sense here is we're going to see further tightening over the next 6 months.
Peter, apropos Southeast Asia, Jakarta Composite up 33% year to date. Does your view on Southeast Asia extend to this market?
Well, it has been the best performing market this year for sure. Just as Thailand was the best performing market last year, it's been one of the worst performing markets this year. My sense here is that perhaps Indonesia in 2004 may have overreached itself a little bit. There's been a lot of good news in that economy with the restructuring and so on. However, my thinking over the next 12 months might be that in 2005, Indonesia probably will not be the best performing market in the region. However, it's probably going to be an okay performer, and it's not entirely expensive at this point. We're still seeing some decent growth, and the restructuring story in many corporates is still alive and well.
And what about Japan, Peter? Would you be getting into that market right now? We've got GDP data due later in the week.
Yeah, Japan as an economy is certainly going to slow down next year from its breakneck pace earlier this year. We're still very committed to the story that Japan has come through the worst of its problems over the last decade. We are going to see, I believe, some modest asset reflation in Japan over the course of the coming year, certainly in areas such as in property. So we're reasonably encouraged by Japan, but it's hard to think that with a slowing economy, we're going to see a massive bull market in Japan. I think you're going to have to pick your spots. There will be some domestic consumption stories that I think will perform well. We're expecting the real estate investment trusts to do well simply because they're very high-yielding instruments in a low interest rate environment. So pick your spots and you'll do probably quite well in Japan.
Okay, Peter, thank you. Interesting as always. Peter Churchouse, Director at Lim Advisors, joining us live from our studio over in Hong Kong.